Well, a top economist is taking on Wall Street pessimism. Mark Zandi is tweeting this week, "I'm confused by the overwhelming consensus among economists that recession is all but inevitable. This view invariably rests in part on the yield curve inversion. Fair enough, it's a prescient recession indicator, predictor, I should say. But so too is the stock market, and it's not signaling recession." Mark joins us now. He's a chief economist at Moody's Analytics. Mark, it's good to have you with us. It is rare that we have an economist that says, listen to the stock market and not the bond market. But you think that there are too many distortions in the bond market right now?
Yeah, I think the message is muddled from the bond market. And of course, we're talking about the yield curve, long-term rates versus short-term rates. And there's a number of factors, I think, that are making it difficult to interpret. But, the most obvious is the Fed's quantitative easing. I mean, just to give you a sense of that, if you look at the balance sheet, the Fed's balance sheet today, they have roughly $5 trillion of Treasury securities, mortgage-backed securities with maturities of more than 10 years on the balance sheet. That's more than double what it was back just prior to the pandemic, $2.5 trillion increase. So you do a little bit of arithmetic, you could pretty much explain away the inversion of the curve by that fact alone. But yeah, I just think I would not rest. I would not be a slave to the yield curve, certainly not in the current environment, given all the distortions that are possible here.
Yeah, Mark, this is not meant to be glib in any way, but I think for 10 to 12% of our fellow citizens, they get insulted when they hear people like us talk about recessions, because for them, this is late 1920s, 1930s environment, without question. We don't talk about it, but it's out there, no doubt about it. So my question to you is, let's just say, for the sake of argument, we're in one or we're going into one. What changes? I mean, I think we all feel how things have slowed down. What does it matter if its definition is met?
Well, I mean, I'm not sure what you're, and I'm not trying to be glib either, but I don't understand what you're saying. I mean, the unemployment rate is 3.7%. I mean, the number of unfilled job positions,
and there are people waiting on, and there are people, and they're probably. Yeah, and there are probably 12 million people in this country that are wondering where their next meal is going to come from, have to decide whether or not they're going to feed their kids, pay their bills, heat their homes. So the easy money for years that have left them in the dust is now leaving them in dust on the other way. So what my point is, those people watch this and they say, recession, we're longing for a recession because for the last 9 months we've been in a depression. I'm going to use the word just to make myself abundantly clear.
Yeah, no. I mean, you make a great point. I mean, I'm painting with a very broad brush across the entire economy, across all 130 million American households. So, yeah, I mean, low-income households are getting crushed here. And for them, this is a depression. But, for the overall economy, all 130 million American households, it's not. A recession is a broad-based, persistent decline in economic activity. Broad-based means lots of industries, not just housing, not just manufacturing, but a lot of industries. And persistent means over a long period of time. And the tell is employment, jobs, unemployment. That's not consistent with the idea that we're in recession, or even that we're even close to going into recession. I mean, at this point, we're creating a boatload of jobs, and certainly enough to absorb the labor force, the growth in the labor force, and keep unemployment low. So, I think that's histrionic to call this the 1929 or 1930. Yeah, certainly there are a lot of folks that are struggling here, no doubt about it, and not to make light of that, but in aggregate, the economy is growing. It's not in recession.
Mark, we're just about out of time, but I was just wondering how you think about the reopening of China in terms of how it has taken place and how you see it. Because on the one hand, you can say, well, economic activity will in fact pick up, and that will be inflationary, or that the way it's reopened and the way it's been handled is going to cause supply chain issues, and that is too inflationary.
Yeah, you're right. You can cut that in two different directions. My sense is that right now, a soft Chinese economy is probably not such a bad thing for the U.S. economy. It's keeping oil prices, commodity prices down. And the most significant threat to the economy, the thing that would throw us into recession, is if oil prices spike again. If we go from, $3 for a gallon of regular oil unleaded, which is right where we are today, back up to $5, which was the record high back in June, we're done. We are going into recession. That would be those low-income American households. They would be completely hammered. They pull back in, and we go into recession. So, in my view, that's the most significant thing, certainly at this point in time.
Right. Mark, thanks. Mark Zandi of Moody's Analytics. Grasso, interesting because, last time we talked to Paul Sankey, he was forecasting oil to go to 120 next year, which would probably mean $5 a gallon.
Yeah, and oil is definitely in a trading range, and we've seen that lower end of that range be right around $70. The upper end is $130. I just think that we're not going to break out of that range anytime soon. I don't know if we'll break 100 to the upside, but if you look at China demand, if they're looking for if they're going to add another 1 million barrels per day as far as demand, that usually equates to a $10 to $12 price in oil. So you look at where we are in oil, let's call it mid 70s. So let's just say that will be 90, 95, and that big bubble is 100 in oil.